Today is January 2nd, 2026. Just 4 days ago, on December 29th, 2025, something extraordinary happened in the silver market. And if you held silver, you probably felt it in your gut. The white metal touched an all-time high of $84 per ounce. Then, in what can only be described as a financial earthquake, it plummeted to $73.72 within hours. That's a crash of more than 12% in a single session. But here's where it gets interesting. This wasn't a natural market correction. This was triggered by a single decision made by the Chicago Mercantile Exchange, the CME Group. They raised margin requirements on silver futures at the exact moment the rally reached its peak. Coincidence? Or something more deliberate? The question everyone is asking is simple but loaded. Did the CME rig the crash to save institutional players who were caught on the wrong side of history's greatest silver squeeze? Let's rewind to understand how we got here. 2025 was silver's year. While most people were watching Bitcoin and tech stocks, silver quietly became the best performing major asset of the year. It started January at around $29 per ounce. By late December, it had nearly tripled. Why? 3 reasons converged into a perfect storm. First, industrial demand exploded. Silver isn't just a shiny metal your grandmother keeps in a drawer. It's the most electrically conductive element on Earth. Every artificial intelligence chip, every solar panel, every electric vehicle needs silver. As AI infrastructure expanded and countries doubled down on green energy, the world needed more silver than ever before. We're talking about a physical deficit of over 300 million ounces in 2025 alone. Second, supply couldn't keep up. Mining production has been relatively flat for years. Well, you can't just snap your fingers and open a new silver mine. It takes a decade and billions of dollars. Meanwhile, existing deposits were being drained faster than they could be replenished. Third, and this is critical, investment demand surged. Retail investors, the so-called silver stackers, had been preaching about a silver squeeze for years. In 2025, their prophecy started coming true. Social media lit up with predictions that the COMEX, the Commodities Exchange, would run out of physical silver to deliver on futures contracts. When word got out that vault inventories were at historic lows, everyone wanted a piece. By mid-December, the short squeeze narrative had taken hold. Hedge funds and bullion banks who had bet against silver were getting crushed. Lease rates, the cost to borrow silver, spiked above 39% in October, forcing massive short covering. The price shot past the 1980 high of $50. Then it kept climbing, 60, 70. On December 29th, it touched $84.01. Then came the hammer. On Friday, December 26th, 2025, while most people were enjoying the holiday weekend, the CME Group issued advisory number 25393. The timing was suspicious. Silver had just put in its strongest Christmas week performance in history, outpacing every major asset class. The advisory announced that initial margin requirements for March 2026 silver futures would increase to $25,000 per contract. That was a 13.6% increase from the previous level of $22,000. But here's the kicker. This was the second margin hike in less than 2 weeks. Combined with earlier increases, the cost of holding a silver futures position had effectively tripled compared to early 2025. Let's break down what this means. When you trade futures, you don't pay the full value up front. You post margin, which is like a security deposit. If margins go up, you need to deposit more cash immediately or your position gets liquidated. For smaller traders without deep pockets, a sudden margin increase is a death sentence. When the markets opened Sunday night, December 28th, the impact was instantaneous. On the Shanghai Futures Exchange, silver gapped down. Within hours, the global spot price had crashed from near $84 to $73.72. Billions of dollars in leveraged long positions were forcibly liquidated. The retail traders who had bet their savings on the silver squeeze were wiped out. By Wednesday, December 31st, silver had extended its losses, trading below $72. In just 72 hours, the metal had dropped over 17% from its peak. Mining stocks collapsed in sympathy. First, Majestic Silver fell 4.13%. Pan American Silver dropped 5.8%. Fortunes evaporated. The CME's official justification? They needed to align margins with volatility. After silver surged more than 90% in 2025, they claimed the move was necessary for market stability. But critics saw something else. Market manipulation designed to protect the big players. Act 3. The conspiracy or common sense. Debate. Here's where we need to put on our investigator hats and look at both sides. The case for manipulation is compelling. The timing was almost too perfect. Silver hits an all-time high, threatening to break $90, and suddenly the exchange raises the drawbridge. The margin hikes forced smaller traders out, but gave institutional players with deeper pockets time to unwind their massive short positions. This isn't the first time the CME has been accused of this. In March 1980, the same exchange then called COMEX, changed the rules mid-game during the Hunt brothers' attempt to corner the silver market. They implemented Silver Rule 7, which restricted trading to liquidation only. The Hunt brothers went bankrupt, and silver crashed from $50 to under $11 in weeks. That day, March 27, 1980, became known as Silver Thursday. The parallels are eerie. Once again, silver was surging. Once again, the exchange stepped in. Once again, retail investors got crushed while institutions survived. But there's another angle. History shows that in March 1980, the Hunt brothers were trying to manipulate the market themselves. They had accumulated massive positions to artificially inflate prices. The CME's intervention, while brutal, prevented a systemic collapse that could have destroyed the entire commodities market. So what about 2025? Was this different? Market analysts point out a critical distinction. The Hunt brothers were two wealthy individuals trying to corner supply. The 2025 rally was driven by genuine industrial demand and a structural supply deficit. The fundamentals were real. China was hoarding silver for its domestic industries. The United States had just designated silver as a critical mineral for national security. Global inventories were genuinely depleted. Michael Hay, head of commodity research at Societe Generale, tried to calm the panic. He noted that year-end trading is so illiquid that normal-sized orders create massive price swings. He argued that investors shouldn't read too much into the volatility. But that explanation doesn't satisfy everyone. Let's examine the evidence more closely. On November 24th, 2025, just 3 days before the first round of margin hikes, the CME announced plans to migrate its Globex trading infrastructure to Google Cloud. The preview phases were expected to begin in 2026. Then, on November 27th, the CME experienced what they called a cooling failure at their Chicago data center. Trading was disrupted at the exact moment silver was breaking out to new highs. The facility, CHI-1, is leased from CyrusOne, a third-party provider. The CME had sold the building in 2016 for $130 million and leased it back. Security analysts called this a textbook third-party risk management failure. The CME, which processes over $26 million in daily contract volume, doesn't even own the building that houses its critical infrastructure. And the cooling failure happened at the most convenient moment imaginable for entities caught short on silver. Coincidence? Maybe. But when you connect the dots, a pattern emerges. Technical glitches and regulatory interventions seem to occur when markets threaten to move in directions that would devastate institutional positions. Remember January 2021? Robinhood restricted trading during the GameStop short squeeze, protecting hedge funds while retail traders were locked out. In March 2022, the London Metal Exchange canceled $3.9 billion in nickel trades when prices surged 250%, saving a major Chinese producer from bankruptcy. Over and over, when retail investors start winning, the rules change. But wait, there's a geopolitical dimension that makes this story even more complex. On January 1st, 2026, yesterday, China implemented a strict license-based management system for silver exports. China controls the vast majority of the world's refined silver. This policy effectively means China is hoarding its silver for domestic use in AI and green energy industries. This was announced in late December, right as the crash was happening. The timing raises questions. Was the CME's intervention coordinated with broader geopolitical forces? Western regulators might have seen the writing on the wall. If China cuts off silver exports and Western markets are simultaneously experiencing a massive short squeeze, the entire commodity system could implode. From this perspective, the margin hikes might have been a desperate attempt to cool the market before the China export ban triggered an even bigger crisis. In other words, the CME might have been trying to prevent a disaster, not create one. The counterargument is equally compelling. If the supply situation is as dire as it appears, then suppressing the price through margin manipulation only delays the inevitable. Physical silver is still in deficit. Industrial users still need it. By forcing a paper market crash while physical demand remains high, the CME has created a divergence between futures prices and reality. In Shanghai, physical premiums remain stubbornly high. The premium, the extra amount buyers pay for physical metal over the futures price, hit a record $8 per ounce on December 24th. That means even as paper silver crashed, people were still paying massive premiums to get their hands on real metal. That's not normal. That suggests the paper market has disconnected from physical reality. Let's talk about who got hurt and who came out ahead. The primary victims were leveraged futures traders and smaller retail investors. These were the people who believed in the silver story, bet their savings, and got caught in the margin call massacre. When you're trading on leverage and the exchange suddenly triples your margin requirements, you have two choices: deposit more cash or get liquidated. Most retail traders don't have an extra $50,000 lying around. Some mining companies also took hits. First, Majestic Silver and Pan. American Silver saw their stocks drop 10% in a single session as the metal crashed. But here's the interesting part. The companies with the best cost structures and those with royalty agreements actually benefit from this volatility. Wheaton Precious Metals, a streaming company, barely flinched. Their costs are fixed at much lower levels, so whether silver is at 84 or 73, their margins remain healthy. And the institutional players, the ones who were allegedly short and facing disaster, they got a lifeline. The margin hikes gave them breathing room to unwind positions without triggering a cascade that would have destroyed their balance sheets. Critics call this a bailout disguised as regulation. The CME didn't just raise margins randomly, they did it at the precise moment that would inflict maximum pain on retail longs while saving institutional shorts. So where do we go from here? As of today, January 2nd, 2026, silver is trading around $70 per ounce. That's still more than double where it started last year. The crash wiped out the latecomers, but the fundamental story hasn't changed. The supply deficit is real. China's export ban goes into effect today. Industrial demand isn't going away. Artificial intelligence isn't slowing down. Solar installations are accelerating. The world needs more silver, and there isn't enough to go around. Analysts are watching the $70 level closely. If it holds, it could serve as a launchpad for another assault on $80 in early 2026. But if the liquidity crisis worsens, a deeper correction toward $50 is possible. There's also talk of a great divergence emerging. Western paper markets, controlled by the CME and COMEX, might increasingly become irrelevant to the actual price that industrial users pay. We could see the rise of physical-only trading platforms that bypass traditional futures exchanges entirely. Shanghai, not Chicago or New York, might become the real price discovery mechanism for silver. This would represent a permanent fracturing of the silver market, where the official price becomes a fiction and the real price is whatever you can negotiate for physical delivery. If that happens, the CME's intervention will be remembered not as market stabilization, but as the moment they lost control of the narrative. So, did the CME rig the $84 crash? Let's weigh the evidence. On one hand, the timing, the scale, and the historical precedent all suggest intentional intervention designed to benefit certain market participants at the expense of others. The pattern of technical glitches, rule changes, and margin hikes consistently favoring institutions over retail traders is hard to ignore. On the other hand, the CME has a responsibility to prevent systemic collapse. If the silver squeeze had continued unchecked, with China's export ban looming, we might have seen a catastrophic failure where the exchange couldn't deliver physical metal on contracts. That would have been far worse than a controlled correction. The truth probably lies somewhere in between. The CME likely saw a market spinning out of control and made a calculated decision to intervene. Whether that decision was motivated by protecting the financial system or protecting well-connected institutional players probably depends on who you ask. What's undeniable is that retail investors bore the brunt of the damage. The people who believed in silver's fundamentals, who bought the dip and held through volatility, were forcibly liquidated by margin calls they couldn't meet. Meanwhile, the institutions with billions in capital reserves survived to trade another day. This raises uncomfortable questions about market fairness. If exchanges can change the rules whenever retail investors start winning, are these markets truly free? Or are they rigged in favor of those with the deepest pockets and the best connections? Closing. The silver crash of December 2025 will be studied for years. It's a case study in how modern financial markets operate, how exchanges wield power, and how quickly fortunes can be made and lost. Whether you see it as necessary intervention or blatant manipulation probably says more about your view of the financial system than about the facts themselves. What's certain is that the silver story isn't over. The fundamentals that drove the rally to $84 haven't disappeared. The supply deficit remains. China's export ban is now in effect. Industrial demand continues to grow. The question isn't whether silver will rise again. It's whether the next rally will be allowed to run its course, or whether the CME will once again step in to stabilize the market. For investors, the lesson is clear. Leverage is dangerous, especially when the exchange controls the rules and can change them at will. For the rest of us, this is a reminder that markets aren't always what they seem. Behind the charts and the price tickers are human decisions, institutional interests, and power dynamics that don't always align with the fair and free markets we're told exist. The $84 crash happened. Whether it was rigged depends on what you believe about who the financial system is designed to serve. And that's a question worth investigating long after the dust settles on this extraordinary year in the silver market.